I just sent over $700,000 to put a multifamily property under contract, even though the market has been going up and down. And we don't know if we're at the bottom or if we're close. But I'm so confident that now is the right time to be buying and investing in multifamily apartments. I'm putting my money where my mouth is and where it's been. If you've been watching the Gray Report over the last several months, I've said the window is open and it's not going to be open for too much longer. So if you're an accredited investor, listen up, because we do have a new investment opportunity at Gray Capital. It's in our backyard in Indianapolis, Indiana. Today on the Gray Report, I'm going to be sharing a little bit of information about that property, kind of just in the day in the life of an apartment operator. Tell you a little just about my schedule today, because I'm going to be all over the place, raising money, inspecting units, doing research, cranking out on underwriting and due diligence. It's a wild ride. I wouldn't have it any other way. But also, because we have to stay up to date, we've got some great reports Dr. Matt Bosnagel's put together looking at really affordability from the renter, the consumer, and then also looking at some of the spreads that lenders are charging on multifamily properties. Some of these spreads are coming in, and as Matt and I were just talking about, does that mean that these lenders are seeing a little bit less risk in the market, or do they just need to do some more business and get some fees? We're going to be talking about all of this and more on the Gray Report. Strap in. Let's get into it. Welcome back to the Gray Report. Joined again by producer of the Gray Report, Director of Communications and Marketing here at Gray Capital, Dr. Matt Bosnagel.
Hello.
Matt, it's a busy week. It's a fun week.
It's been a busy couple weeks, I think.
Yeah, busy year, I guess. We kicked it off pretty strong. We went over a year without having any deals. Over a year. Because the prices, what sellers were looking for and what interest rates were, and then the relative cap rates to interest rates.
Yeah.
And then just trying to stick to, what type of risk do we want to take in the market where there's a lot of uncertainty. So we didn't do a deal because we didn't think that the deal there were actually deals out there. I mean, we put offers all over the place. Yeah, the market just slowed down. I think volume was down 70%. We kept putting in bids that were 20, 30% below what the brokers were asking for. They were looking at us like we were crazy, but time goes on, then all of a sudden now the market is down 25, 30%, kind of right where we were thinking we had to be.
Takes that long for things to erode.
It takes a while. I mean, people are even on the flip side of this, people are talking about, all right, well, if interest rates start to come down, that's a big if.
Yeah.
Cap rates are going to shoot right back down, and there may be a little bit of truth to that, of where people are definitely going to get back in the market and cap rates are probably going to decline a little bit, but it takes so long for that actually to occur meaningfully, because people are always operating. They're fighting the last war. They're fighting what's been going on the last year or so. There's still going to be some nervousness, some reluctancy. And then, like we've talked about, it takes 90 days, 120 days from, all right, we're going to put the offer in until we actually close. Yeah. So it just from the mechanics of doing the deals, I mean, you're a good, half of a year, 3, 4, 6 months kind of delayed in terms of, pricing activity in the very liquid public markets and bonds and treasury rates to actual, real estate transactions. But we're in a different environment right now.
It does seem like cap rates compress at a greater rate than they expand, at least in the past 4 years. Yeah. But I wonder, how much these challenges. We're still in a huge wave of supply. That doesn't make it incredibly attractive to invest in apartments. As we're maybe going to talk about a little bit, insurance rates are just abysmal. Yeah. And there are challenges to owning multifamily. Now, if you again take a snapshot, that's a bad look. But if you look at the trend, then it's a lot more favorable.
Yeah. No, there's some short-term challenges, and different markets are very different. Different regions. Like the coastal markets right now, including Florida, which is, tons of great growth. But the insurance costs, I mean, Florida is it's almost like uninsurable in many cases. And many providers and carriers have just left the market, put their hands up and saying it's just not a risk we're willing to take. But even in the Midwest, I mean, insurance is up, but it's still insurable. It's still like makes sense. I mean, we don't have hurricanes, we don't have those natural disasters, but it's still a really big challenge. But to your point, Matt, real estate, any market really can continue to grow when we have a little bit more certainty. Now, but that risk and return are directly correlated. So certainty means lower risk. I mean, it also means lower return. So if you know exactly how the next, you have a really good indication, how the next year, a couple of years are going to be, like especially with interest rates. I mean, that's how when we operated, when we got into the business back in 2015, even a little bit before that. Interest rates, they moved around a little bit, like a little bit. And you even when we were doing a lot of like bridge to HUD transactions, which when we do that, you take out a short-term bridge loan that's floating rate, and you stay on that loan for maybe only 6 months, 9 months. Which gives you the time to go through the process of putting these HUD loans, a 223F loan, which is it's a little bit more work and challenging to get. It's like this long process, but you get an incredible rate, 35-year term, 35-year amortization. I mean, we locked in $60-some million of debt at 2.7% in 2020 for 35 years. So it's Bridge loans have gotten a bad name recently, all floating debt. But it's a tool. But it was a period where the Fed funds rate, or SOFR, isn't going to move around that much. It's within a really narrow band. There's not a risk if it's going to spike up. And so you could reasonably project, and really the interest rates moving around were so minimal that you put your fixed rate debt on it. It was easy to do. Now, it feels like you have to run through a crucible. You
don't know what tomorrow's going to do.
You don't know what tomorrow is going to be. I mean, on the next CPI report, the PCI report. Some bond auction goes a different way, or whatever it might. War in the Middle East. And so not even like getting the bridge loan and waiting 9 months is going to be okay. It's we're going to put a deal under contract, and then we're going to transact in 60 to 90 days. But the 10-year Treasury, I mean, a month ago the 10-year Treasury was at 4.7. A month before that it was 4.4. And now today it's 4.4 again.
And supposedly, according to some of these articles, supposedly it was one day in the threes. This was in 2023, and I still can't imagine that.
100%. Yeah, it was in the threes. Yeah. So this opportunity, or this environment, creates opportunity. I've talked, it's a fog of war. People aren't sure what to make of it because of the risk and its uncertainty. But when you start to quantify it, it really comes down to a lot of short-term risks. And when we look at the long-term fundamentals, not even just medium-term, it seems like it makes a lot more sense as long as you kind of assume the worst case scenario over the next 2 years. And you can get through that just fine, because there will be, according to all the data, a lot of growth on the other side in 2025, 2026. And that has nothing to do with interest rates. Interest rates are just if interest rates come down, and it has to be an if, and you can't make any decisions saying interest rates will come down. But if they come down, you're going to want to have bought a bunch of assets to refinance. That's not the time. I mean, will the market be fine? Can you do good? Probably. But the absolute best deals of the decade are going to be done in 2024. And some probably happen in 2023.
And that's interesting, too, because some of the reports that we've covered in previous weeks were about how private investors were a little bit more active, a little bit more interested in the market at this moment than institutional investors. Now I'm seeing signs of institutional investors recapitalizing or trying to get a little bit more money to start moving again. So they're anticipating, but they're a sluggish beast. It's hard to move a large institution, and these little smaller private investors are coming in and snapping things up because they can see it. I think the institutions can see it too. It's just harder to get things moving at the scale that they're moving. All these people are finding in general opportunities, and they have a specific attitude toward the market, but things are moved by specific opportunities that come in.
It's true.
Specific properties, and one of them earlier this year was River Club, and we were ecstatic about it, especially coming in after so long without without an acquisition. And then I don't want to say that we're more excited, but I will say that I am personally more excited because it's near my childhood home.
Your parents.
This new
so
property.
You grew up. As a crow flies, like less than a mile away.
I used to drive by this beautiful new property that Great Capital is under contract for, and we drove by it every day. My parents always joked about living there one time when they want to retire on the river. But I'd love for you to just kind of introduce the new acquisition from Great Capital and a little bit about what drew you to it. It's on the tip of my tongue. I'm really excited about it for sure.
Well, yeah. And I think it's a question of, why are we compelled to make an investment now? We haven't invested in a deal, well over a year. We haven't hadn't acquired a deal until earlier this year. We got a deal in Evansville, Indiana, River Club, that we successfully closed. Great asset, more of a value add strategy. And, historically, Great Capital, we've had two primary investment strategies when it comes to multifamily. And, they're relatively similar, but slight differences. One is more as our value add silo, which we're looking at properties that aren't too old, really kind of built in the 80s and 90s, maybe early 2000s. They're looking for they kind of need some physical improvement, but they're stable, they're occupied. They can produce cash flow day one, but there's a true opportunity to go in and physically do some things. Fix up the units, fix up the clubhouse. To bridge the gap between where that property might be and the surrounding assets, but then force appreciation by charging a premium on the rent after we've renovated the property, making it nicer, making it look like the newer properties, but still, and this is the key to all of our investments, add the value to the asset. Show the value to residents, make it compelling that this is a really nice property and they're getting a true value relative to the other options in the market. It's really important to understand what the comparable properties are, not just what their rent levels are, but what do the units look like? What's the square footage? What is the finish level? When that prospective resident walks into that unit, what's the feeling that they're going to get? What is the feeling that they will get when they drive on the property, walk in the clubhouse? And then how do we line up? These are, certainly money, budget-driven decisions, but they're also highly emotional. Where you're going to live, where you're going to spend your time, where you're going to raise your family. And so there's obviously a lot of emotion tied up in that, envisioning the time I'm going to spend the next year. So, that's the value add strategy. Core Plus is a little bit different, and Core Plus is really, we're always, looking for high intrinsic value, but typically we're looking at what's a property that is, newer, very high quality, that the rents are still though, a couple $100 below some of the comparable properties in the market. And often we find opportunities, we're buying these from most often, large institutional groups that are mostly, not always, but most of the time, not local to the market, not even local to the region, have, third-party property management. We can go in there and just run them better and find sometimes some opportunities to add some additional value as well. And so this new opportunity, it's in our backyard. You said, you're from Indianapolis, I'm from Indianapolis. Our headquarters is in Indianapolis. We're actually just right down Keystone Avenue from the property. So you said we know it really well. We love the Indianapolis market. If you're a listener or viewer of the Great Report, we talk about it all the time. I kind of took the Indy for granted for a couple of years. I was reading everything I could. The Sun Belt sounded like the best place to invest. That's where all the population growth, and I'm from Indy, so I just kind of took it for granted a little bit. And until I started doing a lot more research in some of these other markets and underwriting deals in the Sun Belt, and in the Southwest and everywhere, because, what I had read was that, you can invest anywhere in the country. Don't just look in your backyard. If your backyard is good, and maybe if your backyard isn't even as good as maybe another market, but if it's pretty solid, your knowledge of that market and your relationships in that market lower the risk and give you a competitive advantage that when investing out of state, will never have.
Yeah.
Like I will never know a market like Indianapolis. I could live somewhere else for a couple of years. I could spend months somewhere. I'm not going to know the intricacies, the history, the little pieces of facts, what was there 10, 15 years ago, and then who all the people were. On the opportunity that we have right now, Solana, like all the comparative, it's so easy compared relative to a property in a market that I'm not so intimately familiar. Like I know all the comps so well.
Yeah.
Like I remember when they were built. I know who built them. I'm friends with a lot of the developers.
Yeah.
I'm an investor in some of them, or I was an investor and we sold it. Or I know the operator that owns it now and that runs it, or I know the property management company.
Yeah.
There's so much nuance and detail that you can have when you're investing. On the flip side, you don't want to get like too emotionally caught up in a deal or a market. Just because this is our home, this is our backyard, and you live nearby, like that's not a reason to do anything.
Yeah.
But when all the numbers make sense, the market makes sense, you can operate it. You have to start moving forward. And on this deal, it's a big one. We're going to be raising almost $30 million. And so we had to buy it at a price where we could produce and project really good returns so we could attract that type of capital.
Yeah.
But for us, it's a great opportunity to own a high quality piece of real estate in an incredible location on the north side of Indianapolis, Washington Township schools, best schools, in Marion County, in Indianapolis, immediately down the street from like all the best shopping where like a ton of the office jobs are, where a lot of the growth is, just immediately north and Carmel, Fishers, all the north side suburbs in Hamilton County. And then, the rents, Matt, $200 to $600 below, just relevant comps. You go down the street, property was built in the same year, not as nice of a location, and the rents are $400 more. So to me, that's a very direct path to organically move rents. We can operate it more efficiently. We're local management. We're down the street. We've got our whole team here, so we can run it smoother for cheaper, move rents to market. But then also, we look, maybe we can inject some CapEx and make sure that the property is going to be modern and relevant for the next 10 years. The property was built in 2014, so it's newer. That they're building how they built it then is similar to how they're building them today. The interior finishes are 95% of the way there, but there's a couple things that we can do to not spend that much money, but to really give it the legs to be able to perform and stay relevant for the next 10 years. So then when we go and sell it in year 7 or so, the next buyer is going to come in and say, all right, this property is ready to go. It's relevant. I'm not going to have to put nearly as much money in. And so but we don't need to redo the countertops or the cabinets. It's more smart technology, keyless entry, smart thermostats, new kitchen faucets, some new lighting, just to give that impression. So we're going to have a great first impression coming into the property. We're going to paint the exterior. That's what we're doing a lot of these core plus assets and strategies. It's a couple years old. Give it a new, bold look, paint the exterior, and then go in, make some really small tweaks to the interior finishes that draw the eye. You sell real estate based on the kitchens, right? You're going to walk in, see a really nice statement piece, faucets, some nice new lightings, the technology on the wall, the technology at the door. I mean, just the keyless entry. What's going to separate a nice enough but older property versus the brand new thing? I mean, when
as a sign that someone's been renovating or that someone's paying attention to it.
If you're using the physical key. My 8-year-old gave me this thing. But if you're using the physical key, which is fine, I like physical keys. But using physical keys for the last 1,000 years, right? We've got cell phones. If they've just toured the brand new property down the street and the leasing agent or whoever is touring them opened the door with their phone, and then you go to the next property and the leasing consultant is like fumbling with keys. And they're using the key. There's nothing wrong with the key, but it's the perception of, is this a modern new apartment? Am I going to get the best? what kind of experience am I going to have over the next year living here?
Well, that's what's interesting too, is because you glance at this property and you're like, well, maybe it's too nice,
I got a comment on LinkedIn. They're like, oh, looks like a trophy asset.
Yeah, and what I'm saying is, it's not, it's not necessarily in like the wheelhouse of the value add, or really of our last investment project. That was way more of a value add, and it was something you could wrap your head around, and that's something almost comforting. Even when I'm talking with our investment team, is like, well, yeah, people can see the value add. That's easy for us to pitch. But when you see it's a really nice asset, then you're thinking, oh well, everyone's going to compete with it. Oh well, where can I add the value if it's already so nice? And is it a thing, like we talked about, where it's not risky enough to be profitable or to have as high returns? Now, some of what you said there is you look past it and you kind of see opportunities here, but I keep thinking about the moment too, and that's created enough risk for people, maybe to jump out of it.
No, it's a really good point, and you're right. A lot of investors, will look at a deal, not all, but a lot, and they'll want to say, where is the value add? What are you doing to the property? Are you just going to buy it and just hope that things just keep doing well?
Yeah.
And there's not, and the rub there is, and why investors ask that, and it's a good question. Is that it's like, all right, can you quantify? You're saying you're going to grow the property above maybe the organic rate of growth. Okay, what are you going to do to achieve that? Why hasn't that been achieved in the past? And quantify it.
Yeah.
And usually pointing to, we're going to mark to market and move rents up. That can be a good story, and that often can happen. But a lot of investors, they want to see something more. They want you to see you doing something and changing the property, making some sort of investment into the property, especially if you're going to be holding on to it for a long time. Because sometimes you can buy something and you don't need to do much. It's in great shape. But things happen. It's real estate. For example, this property, it was built in 2014, but a lot of the trim on the siding, the white trim, it's fading. It's weathered.
Yeah.
And from a distance it looks nice, but then when you get closer, I'm a prospective resident, maybe you don't notice it, but all the details add up.
That's
so
what
it's like,
thinking,
but it's hard to do that if you don't plan to do that stuff from the beginning. You can't 2 years from now say, let's paint the exterior.
Well, and
let's go find the $500,000 or a couple $100,000 to paint the almost 400 units.
They add up to you from your perspective, and they also add up a little bit to the renter. Maybe they're going to pass over something because I don't know, it looked a little dingy.
It looks a little beat up.
Yeah.
No, exactly. And then when they're comparing the brand new,
comparably dingy.
Well, no, it'll still be nice, but no, it's like people like living in the nice and the new thing, right? The shiny object. So the idea is, if we can if we polish it up, make it shiny, add all the details that make someone click on this is new, modern, and I'm getting that same experience, but then providing it at a discount. $200 to $400 below, the property down the street. That is, it's newer, but basically same area, same market. The floor plans are similar. Ours at the salon, they're actually larger than the comps. Some of them are nicer because they were built as condos. And so when someone tours both properties, they really have to ask themselves, what is the difference here besides the price?
Yeah. So what is the what do you think Salon has that's unique? Yeah. and it's
throwing the softballs.
Yeah, I know.
No. So so great. Couple things. One, large portion of the property was built as for sale condos back in 2009. It was only about 40 units, but they built them as condos. And so there's some very large units that were, the finish level is much higher end than your typical apartment. They're not charging as much as they should be for these units, but in general, the build quality is higher than your normal apartment.
It's like a resort hotel.
It's like a resort hotel. But then the second piece is, again, the location is good, but there's other properties that are in this location. We're on the water. Not just we're on the water. We've got a 20 boat slip marina that we can rent. You can rent a slip. You can put your boat in. We're on a 22 acre bay that we own that's attached to the White River. There's no other apartment community in Indianapolis that has direct White River access. And the White River is the main river that comes through Indianapolis, through downtown. It's a beautiful place, the scenery. And so when we talk about experiences and lifestyle and what the modern renter, the millennials, Gen Z, younger Gen X, what they're looking for experiences. Yeah. And when I look at the comparable properties that again are $400 to $600 more a month, they're behind strip malls, which can be convenient, but you're in a parking lot, literally, or you're behind a mall in a parking lot, or you're behind an interstate. Maybe it's newer, with no interstate access, versus living on this, majestic, on this majestic property, waterfront property. You literally have bald eagles and herons going over you every single morning. Yeah. It's a different vibe completely. Yeah. And I've mentioned this a couple of times. I'm like, I guarantee the mental health of people that are living in Solana versus surrounding properties is notably higher. Maybe it attracts people who are happier because they want to live in that type of environment, or maybe the environment, improves that mental health in general. Yeah. But it is,
you pulling in. You don't want to pull in and right behind the Donatos. No offense to Donatos, but you don't want to pull in behind the. you don't want to be pulling in behind the strip mall. You'd rather be pulling in next to the lake or the bay, or to look out on something that's a little bit more.
I would, and maybe not everybody, but I would, and I think a lot of, again, the renters who are targeting Gen Z, millennials, Gen X, that is what they're targeting, looking for as well.
I'll add here too, and maybe I'm stealing a little bit of your thunder, but I think that the timing of this is great from from an interest rate perspective, or from like a market perspective, but also from that specific perspective of the White River and the stuff that the city of Indianapolis is doing with the White River. They're doing this kind of big dig project where it's supposed to really dramatically increase the quality of the White River in the city, and I am seeing a lot more attention to the people. People are gobbling up these riverfront homes. They're coming in from out of state and they're like, what are you doing? This is great.
Yeah, no, the river has been ignored from a lot of people in Indianapolis for a long time. We grew up here.
It wasn't great for a while.
Yeah, no, it wasn't. It was relatively polluted. There was a fish kill, and that's what a lot of people think of the White River. Yeah, 25 years have gone by now, and it's improved considerably.
Oh yeah,
and I've spent a decent amount of time on the White River now, and people are missing out. The people who have been on the river and have experienced it, it's an eye-opening moment because it's a great resource for recreation. And
it's not navigable by commercial vessels, but it winds its way through the heart of Indianapolis. It's funny, we've got this big river, and then it's like our canals are the ones that have a lot more development. Yeah. And there's a downtown canal, and there's a canal in Broadwell or something, but it's this the river system, I think, is really waking up, and there are more people that I see out on the river, out on boats or kayaks or whatever, and it's only going to increase. So it's really exciting, especially the fact that this big project is going to be done in 2025.
Well, and they're already seeing a lot of the improvements right now. I think they've done most of the work. We had a meeting with the executive director, the Friends of the White River, which is a local nonprofit that we're looking at having a partnership with to help coordinate. There's some grants out there for wildlife restoration, natural grasses, things like that. They want to do training with our site staff, landscapers. What's the best way to maintain this environment? Yeah. But in the conversation with him, a lot the big dig, which they're building this massive tunnel underneath the city. And other cities are doing similar projects. As in the past, they've dumped sewage into the river.
Where does it go when it rains?
Well, and so they're basically building this massive, huge. It looks like a nuclear fallout shelter type massive thing. This massive tunnel where it's basically going to be a holding tank. Yeah. Which has already dramatically improved the water quality.
That's great.
Yeah. Yeah. So it's exciting. I think it's going to finish up next year.
Wow. And there's multiple other projects, not just the Big Dig, but that have been kind of bubbling to the surface throughout
Dig Indy. I think it's
Dig Indy. Okay, all right.
Yeah, Big Dig was in Boston.
That's what I thought. Yeah. We've been calling it that.
It is. It's a big. Yeah, I know.
But there have been other projects in Indianapolis seeking maybe they want to build a little beach here, and I don't know what state there are, but they're kind of bubbling to the surface. People are taking notice, and they're planning for the future, and to have this property be here already, and there's already a boat dock, there are already kayaks there, and there's just so much opportunity to be built out, and as the White River becomes more appealing to people.
So like there's all of what we've been talking about here, the river and all of that. I mean, I think it's like a force multiplier. It is, but it's like the cherry on top. It's the icing on the cake, whatever you want to call it. You have to compete based on, value of the apartment, the individual apartment, based on the rent levels of other, assets nearby, given the location, the proximity to jobs, employment, restaurants, retail, all of that. And if you have all of that and you have the finishes that really compete, and again, you're offering it at a deep value, then you just step in and say, now look around. And you just can't replicate that natural environment. And again, some people want to live behind the mall.
Well, and here's something that I was thinking, though. What if it is too good to be true? There's always something about if it's too good to be true. What do we do?
What do you mean?
What if there's like what do they call this? A huge monster. Sinkhole, a swamp monster. What if there's floorboards could everything could collapse in on itself the minute you touch it? Like, how do you kind of kick the tires here? And what's that process of determining whether, like, all right? Because I know we've had. We've checked it out, but what's the real process where you can kind of eliminate any doubt, I guess?
Well, you're never going to know when you first go in and you put a place of property under contract. You do as much as your due diligence up front as you can, and before you're under contract.
Yeah.
Obviously, you can't get in and physically inspect every single unit before you're actually under contract in your due diligence period. But you got to do as much as you can. Be on site as much as the broker will allow you.
Yeah.
Drive through if you can. In off hours, multiple times a day. And every time you're there, you're looking for different things. You're looking at, between, how many cars in the park are parked in the parking lot at any given time to see, okay, are people working, what type are people who have third shift, but what's the occupancy at a given time? What type of cars are being driven at the property in the residence zone? But then obviously, there's the physical condition of, you're looking at balconies. Are the columns, is there any swelling going on?
Yeah.
Is the foundation doing any settling? If it's raining, get over there. You don't tour the property when it's a beautiful day. It's a great day to see it. That's great for the seller. It looks nice. But, if there's a drainage issue, you're not going to see it. So go after it rains. Go at night, go in the early morning, look at the siding. And these are all the things you start picking up clues, because you can only, it's like we're doing a surface scan. We can't see inside of it, just yet. And so what are all the different pieces? Because then if you see deferred maintenance on the outside, you can anticipate there may be some on the inside as well. And so then you try to do as much to anticipate what we think we're going to need to bring to the property once we buy it before we were under contract. And so we're building out our budgets. But then once we get in there for due diligence, which as soon as we finish this podcast, I'm popping over there and we're basically using the property as we're doing physical inspections. We have our whole asset management, property management, construction teams over there today, using it as a forward operating base, because I've got going to meetings as well with some partners and potential investors that are on the north side of Indy. But we're getting into every single unit. We're going to walk 100% all 384 units for a couple of reasons. One, we're assessing the condition. We haven't been in all the units yet. The managers haven't been in all the units. Some people they started working there, a couple months ago. There are some units that have been just so highly occupied, like the condos, that no one's seen them, except when they were turned a couple years ago. And that maintenance guy's not working there anymore. Maybe someone's been in there for routine deferred maintenance or preventative maintenance check or changing filters. But it's like no, a maintenance tech has been in there. So you actually put eyes on it. We're cataloging, with the condition of the mechanicals, what type of appliances, have any upgrades been done. So I don't know how many times you're told that people haven't upgraded any units, and you start going in, you're like, these are upgraded units. You've already spent money. You've replaced appliances. You've already done all of these things.
Guys come in with like a checklist of this is this.
Exactly.
Okay.
We go through and we have an app that we use. The team goes through and we go through and check and monitor, make sure everything's filled out, complete. So because that's our opportunity to take an inventory. There's no other time that we're going to be able to go in and get into every unit and to see and to catalog everything that's in there. So if we do say, hey, let's switch something out, let's change out this light, this appliance. Well, how many have already been switched out?
Yeah.
So we could say, there's black appliances there now. We want to switch out to stainless steel. Well, there are some stainless steel appliances at the property already, but how many? And it's so expensive to send people to do this job again. Lesson learned, previous deals. Like, do it right once. You measure twice, cut once. I mean, that's as simple as it is. It's not sometimes due diligence, and this rubs me the worst way, of due diligence, especially these unit walks. This is why I need to get over there. To make sure it's not a checking the box exercise.
It's not a formality.
It's not a formality. And so often people are like, we got to walk these 384 units, get in there, and we just need to get it done so we can go to lunch. And so you're going through and you're seeing how quick you can do it, and they're check, 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 check. And it can be garbage in, garbage out. And they're like, well, we actually didn't log some of these things, or I wasn't checking on that. It's like, well, we were really going. It's like, you were really not doing the job. So it's critical. Take your time, get it done. You've got 30 days of due diligence. You don't need to do it all in one day. Obviously, logistically, that makes sense. It's hard to get all the people in one place at the same time to knock it out. But you have to be thorough. And so it's not only just units. You're checking mechanicals. You're checking foundations. You're checking windows. Obviously, you're looking at roofs. We're using the drone to inspect. Is everything we don't want to get on a ladder everywhere. You're inspecting everything that you can't see from the ground. You're scoping sewer lines. You're looking at drainage. Hopefully, there's some rain on the ground. If not, we'll have to go back another time to see what it looks like.
Any kind of like paperwork type of due diligence that you're doing at the same time?
Yeah. So we're talking about the physical due diligence of the property. The second part is the financial aspect, and so the large part of that is the lease file audit.
Okay.
And so you got a rent roll here. But what you do is oftentimes the rent roll doesn't match up with the leases. And so you've got your rent roll, and you take a look at every single lease, and you're matching the two, making sure everything is correct, everything's accurate, there's no discrepancies. But you're also seeing if there's anything weird in the lease. And then also you're noticing things, or you're looking out for things like pet rent. Okay, I've seen every single unit's got a dog. But only half the units are being charged pet rent. What's going on? Do you not know the pets? They get some deal. What's the story? You can find units that you didn't know existed. Like literally, it's not on the rent roll, but there's a lease for it, and it's like you have 385 units. Or there was a down unit, and they're like, oh, we just forgot about. Like literally, I've been to properties when there's been like 4 units that they were like, oh yeah, by the way, actually, like, oh well, we've been using that as storage, and so we've got these 3 other storage like sheds full of stuff, and they're because people get lazy, and again, out of state, third party management from far off, and that's all. It can all turn into great opportunities.
I am curious now where we are, and how you've mentioned how this is probably the largest raise that we've done. And what your thoughts about it are. I'm excited. I think it's fun to it's gonna be fun to pitch this really beautiful property to people, and especially our hometown. We've been talking it up for so long. It's so great to have it in our hometown. But I'm not the one that has to talk to investors all day. That's you and the people in our investor team, Blake and Griffin. What are your thoughts about the raise? How's it going? Even though it's only been like 3 days and there's already been like major news about it, and I just can't keep up.
I think it's been 3 days. We've got about $27.5 million to raise. That might move up or down. When we get through due diligence. That's a whole other piece of refining the business plan once you've gotten in there. But it's intimidating to start to say, hey, I've got 30 days to basically raise almost $30 million. And not everybody does it this way. Some people have like all the money in their bank account ready to go. They're buying it themselves, or they've got pre-committed funds. We have a lot of investors that like, give us soft commitments on like, this type of deal. We'll definitely do this. And we have programmatic relationships of people who just come into every one of our deals. But they're not necessarily adding up to $30 million. And so it's we don't always know where it's going to come from. But we know what we try to do is, quantify how much activity is going to be required to get there, how many investors, and drawing the picture, really in a graph or in a chart of, what that looks like.
Yeah.
Even if I don't have names of the types of investors. And so like, for example, on this project, Solana, open to accredited investors only, we can't do it by raising $100,000 at a time.
That's like 200 of them, is that? I don't know how many.
Maybe
That's
add a zero.
Yeah.
Yeah. It's
20 million and whatever. It's a lot.
It's a lot. $100,000.
That was 20 million. Sorry, I wasn't saying 27, but
yeah, no, it's over 2,000. It would be over 2,000 individuals.
Yeah.
At $100,000. That doesn't even get us there.
Well, and I don't
have time to have that many conversations.
Yeah.
So we have to have conversations with larger investment groups. So it's family offices, it's registered investment advisors, it's kind of quasi-institutional groups. We're not really pushing for joint venture, like JV equity right now, because although we're having conversations, but our investors invest with us and me, and they assume that we're controlling the deal, and to have a major investor that can kind of pull some of the strings. I'd rather, it can work out. There's great partners. I'm not saying you never even do this deal, but right now we've got the interest where, we can put together a really great group of some family offices, registered investment advisors, and then some, our, sophisticated ultra high net worth, accredited individual investors.
And I think that it's comforting that we've had years to build this network of people through the deals that we've done, through the conversations that we've had, and through through the investors that the people that we've even worked with.
We've got a track record. Yeah. And people are like, how do you do this? And we started basically at scratch, with very little contacts, and grabbing coffee with people every once in a while, and then started and made a YouTube video that wasn't good at all. It's still on our YouTube channel. Did it, during COVID in my basement. This is when we really ramping up raising capital. Because before that, it was much more kind of just immediate friends and family, and raising a couple $100,000 here or there. But no, the relationships build up over time. But then it's also people judging us for what we've done in our track record, and like you'll hear me if you're pitching you on Solana, you'll hear me say this, but like, we've got a great track record of the deals that we've done in the past. Over 30% IRR. Everybody's got a decent track record over the last cycle. The business got so easy at the end. 2020 and 2021. 2021. Even 2019. The money was available. Interest rates were zero. The money was free. And rents were growing by 20%. So like, you had to really screw it up. And so it's like, we've got 2 times what our returns are projected to be, at 30%. I am proud of that. But I am much more proud of our track record over the last 2 years of all the things that we didn't do, the deals we didn't buy, how we didn't overpay, the fact that our decision to not use bridge debt and floating rate debt in certain situations when we saw the market moving, and that's allowed us to not have to issue any capital calls, to not be distressed, to be in this position, to communicate it, and doing like what we're doing right now, Matt, of communicating our thoughts on the market, our thoughts on deals, and doing, how long have we been doing this now? 3 years?
3.5,
3 years.
Yeah.
So every single week, telling whoever wants to listen, our thoughts on the market, and being consistent about it, and being transparent. Over time, that snowball, builds up. So it's just it's consistent action. That's what led to this. And then we say, okay, let's paint this picture of what it could look like, and let's start filling in the gaps. So we're not there yet. We'd love folks who would want to participate. go on to, greatcapitalllc.com. You can find it there, or I think solanaindy.com is going to be up and running pretty soon.
Oh yeah, it should redirect at this point. But
so solanaindy.com, learn more, get the deck, schedule a meeting with us, and then we've got a great, probably the best investment portal in the industry. You can do all your due diligence. We're transparent. We throw it all up there.
Do you want to type in solanaindy.com? I can cut this out if it doesn't work, but I'd love to see that beautiful landing page. Now
I was on GoDaddy. I was like, why not a custom domain? And I wanted to get like Solana.invest or something like that. Solana Invest was $4,000. Invest Solana was $100,000.
Oh, geez.
Solana in Indy was 23 cents for this year.
Oh man.
I'm like, okay.
That's funny.
Yeah, I was like, I'll buy, and it was like 3 years for $40. I shouldn't have even bought the 3-year thing, but
there we go.
Perfect.
And now our properties have their own websites too, like the ones that for gray residential, like live at.
Oh yeah,
places.
Yeah. So yeah, you could pop on over to solanaindy.com. You can log in if you're already an investor, sign up for the portal, but also schedule a meeting. Watch we have a full deal preview video that really is me for 45 minutes, giving you a full breakdown of everything about Solana, the deal, our thoughts on it. And then, it's a beautiful asset. I'm glad we actually get to see some pictures of it, Matt.
See that picture of that guy fishing?
Yep.
I just wanted to add that as a little color.
Yeah,
lots of things happening on these waters.
Yeah, you did a good job with this one, Matt. So fill out the form, get the deck, schedule a meeting with us. We'd love to have a conversation with you if it's a good fit. And again, you do have to be an accredited investor to participate. That's the SEC telling us that. It's not us. We think you should be able to do what you want to do with your own money. But it's exciting, Matt.
I know this is going to be a fun one. I am excited. It is the biggest number that we've ever had to tackle, but it is something like, oh man. I mean, it's a great product.
Every time everyone's like, "Do you think you can raise it?" And I'm like, "Well, I've been able to do it every single time, and we won't know until we start. And we'll be able to. The type of asset, and again, we bought it at a price, and this is what we told the sellers and the broker. I said, because they really wanted us to obviously pay more money, and there was another buyer that was offering more money than we were. But it was very clear that, look, I'm not going to put this, if we're going to put this under contract, we're going to close.
Yep.
But in order for me to close, I have to raise the money.
Yep.
And so I need to get it at a price that can generate the returns with reasonable assumptions that it's going to make that very easy to raise the money, rather than like, it can't be a marginal deal. It can't be like, well, it's low risk, so it's a low return. It has to be a advantageous risk and return profile. It needs to be lopsided. It needs to be asymmetric. And the fog of war. And when we did put under contract, interest rates were really much higher. The 10-year was. They've come down since then. We used the treasuries being higher as kind of covered. Like, look, we couldn't. I mean, because if rates are going to go to 5% or more, that's what the pricing is telling us, and it's relative to cap rates. And other buyers, were getting out of the market. We held steadfast, confident about the long-term fundamentals, the market, the property. That we stuck to our guns, but had to be at a price that made sense for us and for our investors, and we were confident. We'll be here with updates every week. You can hop onto solanaindy.com if you're a accredited investor to learn more.
Super exciting.
Now let's get into the rest of the report, Matt.
Now, if we can cover one, I want to start, or maybe even end, with this article from John Burns Research and Consulting about a 22-year roller coaster of investor activity in single-family homes. A lot of the articles that I have today, and I'm going to share them separately because we may not have a chance to talk about all of them, but they all kind of have to do with affordability and how the roller coaster of housing affordability.
Is this AI generated, man?
Yes, that was 50% of why I was really loved this article. Now the article's really great, but
Deed and Trust to Home. That's something that is definitely something an AI.
I can't get enough of it. And I'll admit I did try my hand at recreating the picture, and I ended up generating things where the roller coaster cars were actually homes themselves, and people were going down.
yeah,
Some guy had
yeah.
3 hands. It was great. But
Anyway,
yeah, right below that AI picture is actually a really good article. And the main argument here is that U.S. single-family home investment has gone through 7 separate phases or investor periods, call them eras if you want, between 2002 and today. I'm going to run through these really quickly, and I've got a lot to say about them in total. Not as much, believe it or not, about the specific eras themselves than about the graphs that accompany these, which really, I think, kind of run counter to the narrative of investors buying up all the homes and renting them out.
Well, yeah, man. I mean, on the key takeaways, it says, and this flies in the face of what you might see a Redditor comment, but institutional investors are buying less than 2% of all homes.
Yeah.
I thought BlackRock had bought up all the homes, which is,
try less than 1%. And I'll get into that in just a second. And I'm not including iBuyers as because I don't know if that's.
I mean, iBuyer, like somebody's like buying it remotely.
Or there is a category of home purchases called iBuyers where I think it is a way to close with certainty. It seems to me, and I don't know enough about iBuyers to lump them into the institutional class. Now, I think that it uses institutional heft in order to provide a guarantee that things will close.
It's like a platform.
That's what I think.
Individuals are buying through a platform.
So ultimately,
I wouldn't. It's yeah.
So ultimately, though, it is less than 1%. Now, I do want to outline these eras, because that is their bottom line is, hey, look at all these different eras, these different periods. And I'll run through them here. First, they start at 2002. They call that an era. It's not a period, just a starting point. So right now we're at 6 eras. I think there's actually 5, and I'll get to it in a second. The first one they talk about is the easy credit boom from 2003 to 2006. During this period, investors rose to 18% of all real estate transactions. Many houses remained vacant. Really, this was the buildup to the housing crisis. And then the next period that they note is 2007 to today. They call this the Airbnb home conversion boom. This home flippers got into the market starting in 2007. I would also fold that into.
That's when I started.
Yeah, well, and I would fold that into the next their next period, which is the foreclosure boom, when investors rose to 24% of transactions at the peak of the housing crisis in 2013. We all know the story of this. Housing prices went down. Investors went in and they did buy a lot at a discount, but that didn't last forever. In 2014 is the next period, is the iBuyer boom begins and the foreclosure boom ends. So that investors fell to 18% of transactions by 2020 as foreclosures declined. So it wasn't like the amount of investors that are in the single family home market is not static. It's moving.
I mean, like an 80-20 ratio, less than 20% investors to 80% or more, individuals. That seems kind of healthy. To me.
And I think I also the other point here is that things are moving. When the houses are cheap, the investors are going in and buying them, and when they're not, they're not. And ultimately, there's a quote here that talk, and I'll find it in just a second here, but like the investors are not they're not the most competitive, and we've talked about this every year for the past 3 years. The home buyer is going to be able to bid up a higher price.
They can be competitive, but the buyer's looking at it through a different lens. Yeah, exactly. Whereas like a home buyer, they've got emotion tied into it. They're not looking at their ROI. They're looking at what's my down payment, what's my monthly payment going to be, and where do I want to live, and where do my kids going to be
for real. And then the last 2 eras that investor.
The only thing I'd say though, investors can move just typically quicker. And so like if you have if you're in a family and you're like, we like this, but an investor is going to show up and say, all right, cash, I'm ready to close, ready to go. I'm ready to move. I buy properties every day. Let's make this happen.
Yeah.
And so that's the competitive advantage that maybe an investor has over.
And those last 2 eras are the low interest rate home price boom. We've all went through it. And then in 2022 and to now is this rising rates causing a decline. Not too much of a decline, but still a slight decline. For the authors, again, that bottom line is this story of the roller coaster of the highs and lows, and I do think that is a story, and it is worth thinking about. The amount of investments are not static. It's not a monolith. There is different forces at play here. But for me, I get a slightly different takeaway, and that is all about the graphs that they use. So the first graph in the article, it looks at rental homes as a percentage of total single-family homes, and that has been declining, actually, since the second quarter of 2015. Now it is at the same level as it was in 2009.
And that was probably driven by low interest rates, in that era,
Correct,
2020 to 2020, before March 2022, of everyone saying, "Hey, let's go buy a home." Rates are 3% or less.
Yeah, and so
makes sense.
I mean, so that narrative of everyone going up and buying homes, and now you have to rent, you can never own anymore. Well, that narrative is not exactly true. If you're looking at percentages of homes, it is steadily going down. There's nothing.
Well, this isn't saying necessarily how many people are renting versus how many people are owning. This is how many investors are owning single family homes. Those people still may need to be renting.
Oh no,
but they're going somewhere else.
This is renters, single family rental homes as a percentage of total housing units.
Yeah, no, I know, but I'm saying there's just as many renters. There's just less supply of rental housing. Is what I'm saying.
Yeah.
So that's one of the reasons, and that's exactly one of the reasons why single family rents skyrocketed even more than multifamily rents during the pandemic, and still are seeing strong rent growth.
Even more persuasive to me is the fact that we are talking about this percentage that I'm saying skyrocketed up and skyrocketed down. We're talking about 2.5% range difference. So it went from 9% in 2005, which is like the baseline in this graph here. It skyrocketed all the way up to 11.5%, and now we're a little under 10%. So
and that's good context. So I mean, we're a little bit off the peak, and there are a lot more rental single-family homes today than there were back in 2005.
Yeah. So moving on to the second graph, and I'm sorry I'm talking a little fast here. I know we're pressed for time on this busy day. The vast majority of investor-purchased homes are bought by people who own at max 9 properties.
Wow.
I'd love to know how many investor-purchased homes are owned by people who own like 1 or 2.
Probably a decent amount.
Exactly. It's these home flippers. I think so much of this.
Home flippers, or someone who's like, I got a rental, or like, we bought a house and we turned the one we were living to in a rental. And
exactly. That's what I was thinking. And here's the quote that I was going to say here. And it's from a Redfin article on this very same issue of investors in the single family home market. It says, when there's a bidding war for a home, it has become more common for the winner to be the person who actually plans to live in the home. Individual buyers are sitting on a lot of cash from the sale of their previous home and pandemic savings, so they're willing to pay a little more upfront than investors who have to be mindful of the margins. Now,
I thought we saw an article last week that pandemic savings was gone.
Yeah. Now that's what I was gonna say. I was like, that pandemic savings, that's not a good part. I don't believe in that. But it was notable that comes from Redfin.
A year and a half ago. That was maybe the case.
Yeah. But Redfin, I would expect more, maybe, than John Burns to talk about to have a little bit more of a salacious headline about the amount of investment. But actually, this was reasonable too. So everyone's coming to the same reasonable point. Like, investors aren't dominating the market. Market forces are not created by these investors. They're more like followed by investors.
It's an influence, but it definitely is. The market can be influenced by investors. I mean, 18% or so. I mean, that can move the market, but it's not. The narrative, it's so different than the narrative.
The reason why
that institutions own almost all the homes in America.
And I could be remembering this in that same article from Redfin. They said, oh yeah, well, investors, they usually sell their home for 48% more than they bought it. And I was like, I did kind of think like, well, doesn't that happen? What's the comparison? By leaving that out, that made me think, okay. All right.
If you're gonna
tell a story here,
flip it, and
for the regular owner,
if you're gonna put money into it, and that makes sense. You do a nice flip versus a homeowner. Maybe they get a certain appreciation, but it might take 15 years.
Yeah.
So different.
And so these owners of 100 plus homes, this is the third graph here. These owners of 100 plus homes, these faceless corporate owners of investment homes, they're investing at the same rate as 2013. Less than 1%. I'm not including iBuyers here. We could, but again, from 2021 to 2022, that number went up dramatically to just under 3%. But it's less than 1%
money was free. Again, the financing was essentially free, so it makes sense. And this is where the market can get it did get crazy, overheated.
And that's like a big point, and maybe almost more persuasive than just saying, oh, don't worry, it's a tiny sliver. The fact that it's not actively rising, we're not seeing an overdetermined trend where it's just this steamroller of investors that are coming and coming, coming. They're reacting. When things are favorable for them, they'll jump in. When they're not, they're not. And that means that you have control over your life a little bit more, or at least the investors don't have control over your life. And that's
just a little bit of control, the illusion of control.
Yeah.
Matt, before we go, I just want to briefly talk about affordability, because we've got 3 articles. Now, they're all, if you're subscribed to the Gray Capital newsletter, the Gray Report, which you can find at graycapitalllc.com/newsletter, just go to graycapitalllc.com. Got 4 articles, one from Fannie Mae on high insurance premiums continue to impact the multifamily sector, higher insurance costs that does get passed on to renters, assuming the renters can't afford the brunt of that, which that's a question itself. We've talked about, the John Burns article, which can just be confusing because, again, obviously the consumer doesn't have the right vision of the housing industry, of what makes it up, and it's leading them to be, demoralized. I'm never going to be able to own a home if they don't already own it.
Yeah.
Harvard Joint Center for Housing Studies has a piece on rural areas saw disproportionate home price growth during the pandemic. Not surprising, because, you could buy a dirt cheap home, outside of the city.
Yeah.
And what happened during the pandemic? People are looking for more space, get outside of the city,
and they weren't
in the city.
Yeah, they weren't going to different cities. I remember talking about this. They were going maybe to the outskirts of their own city.
And then once you start seeing, it comes, because all of a sudden, there's only so much supply out in, rural America. And if you're looking for a, decently nice house, or you're building something new, all of a sudden, the sales comps were like $150,000, $100,000. Then all of a sudden there's like $300,000, purchase or a home. And then that, that moves the comps, and just everyone all of a sudden, that's what everyone's going to be targeting, because look, they sold their home for $300K or whatever. Why list it for $150?
And this expansion of rural home price, rural home price growth is also, like, I don't think it's as much a story of remote homes, of remote work. It's a story of people going to where it's affordable.
I think affordability, and just the demographic trends. People having kids and wanting a little bit more space. But I think affordability is huge, again, because that first person was able to buy for 150, whereas in the city is $500,000. And now it's 300,000 out in the country, but that's still a deal relative to the city.
It is crazy, even in Indianapolis, and I don't know how it works, if it's the logic of this, because some neighborhoods that are far from the center of the city are more expensive than others that are close. But it does seem like you get closer to the city, the lot sizes get a little smaller. They can be just as expensive, if not more expensive, than a huge lot that's on the outskirts.
So I think that piece is relatively straightforward. And then leading to all of that is, this article from the National Home Association of Home Builders is new single-family home size decline continues. I've seen this, with my own eyes. I mean, this is, up in Boone County. A lot of the new single-family home development. Like they're almost they're not tiny homes, but like they're very small.
Super interesting.
Because they know it's straightforward. Median income is X. The median or average, savings of a home buyer is Y. They can only afford so much. Interest rates, are what they are, and so people can only afford to buy. So they want a home, and so they'll want a smaller home rather than no home.
And this is where I think it's affordability, not remote work.
Everyone
was like, "Oh, people want bigger houses now because the office is inside of the house." And maybe I said that, I forget. But it's not. It's affordability.
That may have been true, and for some people do still work from home. Some people aren't going back to the office.
But it looks like, and you can almost map. I did this. It wasn't exact, but you can map affordability. Case Shiller home prices with this home size, and as the affordability, or as the home prices dip, the home size increase. And it's just a 1-to-1, and it is a very.
This was happening in multifamily also, Matt, prior to the pandemic, because you can get a higher per square foot rent on the smaller unit. I mean, your 3 bedrooms, you're going to have the lowest price per square foot. Versus, a studio, you're going to get the highest price per square foot. Now, but only so many people will live in a studio. The micro apartment thing, that was like, trendy pre-pandemic,
Yeah.
and the pandemic kind of killed it because no one wanted to live in a closet.
Yeah.
But all of this, had not. But to your point, really not about remote work, much more about affordability, because we had affordability issues before the pandemic. People forget that.
Yeah.
And it's wild to think in 2019, people were saying, I don't think rents can rise anymore because we're at max affordability. Impossible for rents to go anymore.
The rent is too damn high, party? That was started before the pandemic.
Before the pandemic. And then rents rose 20, 30% now. And some markets have come down.
Yeah.
But they're still higher than they were. So it's fascinating. Matt, unfortunately, we're going to have to cut this episode short. We're going to have a great episode next week. Matt, you're out of town, but we're going to figure something out.
Yeah.
Hopping over to solanaindy.com if you're an accredited investor, learn more about our latest investment opportunity at Gray Capital. Really excited about it. And then make sure you subscribe to the Gray Capital YouTube channel. Give this video a like and hit the bell icon so you can be updated with every single new video we put out. We've got a webinar next week, Matt. So you hit the bell icon. That way you'll get that alert. I think it's May 30th.
Yeah, May 30th at noon.
At noon. So it's like take your lunch break, learn about some multifamily. I'll figure out lunch at some point. Okay. Thank you for watching. Have a great rest of your week. We'll catch you in the next episode.